Hi, everybody. This is Paul Hitchcock. Thank you for joining this webinar. Very excited for my two guests. I have the founder and senior managing partner of Barth Calderon LLP, Harry Barth. Welcome, Harry.
Good to be here.
Yeah, Harry's a in high demand speaker across the country and putting on at the firm about 40 workshops a year to many incredible organizations. And Barth Calderon is an asset protection, estate planning, business planning firm headquartered here in Orange County, California. That's the building there. And also very happy to have Linda Goldstein with us, who is an incredible Vistage Chair doing great things. Welcome, Linda.
Hello, glad to
Yeah,
be here. This
yeah,
is a
no.
really hot topic, and Harry, I'm excited to be able to be on stage with you today.
Um, I'm happy you're here.
Yeah, huge topic. We're gonna get into it in a minute with Harry. Estate planning, apocalypse, a lot of things everybody should know about. But Lynn, I want to start with you and hearing a bit about your Vistage practice and what you're building out there.
Okay, well, I just celebrated my 4th year with Vistage, so that's pretty exciting. And I have two wonderful groups. I have a CEO peer advisory group. We meet, it's non-competing industries, leaders, CEOs, presidents, managing partner. And we meet once a month, and the only agenda is to help each other become better leaders, make better decisions, and grow their business. Then I also have a trusted advisor group, and that's a group of people who have professional services that they work with businesses, and the agenda in that is also the same. We get together once a month and we talk about best practices. We help each other, and in both groups, I do have some openings, and I just want to mention that I'm looking for people who believe in the saying that if you want to go fast, go alone, but if you want to go far, go together. And
Right.
so
Yep.
looking for people who want to give advice and also get advice and understand the power of collective wisdom. So that's my two groups.
Love it. No, and I know you're doing great things there. We've had a chance to talk about it. I want to tell everybody listening that wherever you're watching this video, because we are going to live stream this everywhere in different channels, Linda's information and Harry's will be around the video. You can get connected to them. And with that, Harry, let's get into it. I know we've got a bucket list here of things we got to figure out. What's going on?
Well, this is a very interesting topic. And I think that today I hope, Linda, to make it more vibrant, to have more understanding of what this is. A lot of people, I've been doing this for close to 50 years, Linda. And, I've been a Vistage speaker, my God, for 20 some odd years. And in this is a very interesting topic because it's mired in what you don't like to talk about, especially in your groups. It's mired in politics. So we're gonna, by its very nature, going to get into a little bit of politics today. So most of your members, most of our clients, are focused primarily on income taxes, reduction of capital gains taxes, reduction of income taxes, both state and federal. It should be. CPAs are focused on income taxes and estate taxes. And income taxes and capital gains taxes. But what we're going to talk about today is there's another whole tax system in the United States of America, which is the transfer tax system. And I think it's important to frame it as a transfer tax rather than an estate tax or a gift tax. The federal government imposes a tax on the transfer of assets. All right. So from parents to children, or by gift or upon death. When it's transferred to the next generation, the government comes in and says, we want a piece of that. Now, you and I, Linda, will never pay a state tax because there's no tax between spouses and there's only tax when we die as far as estate tax is concerned. So most of the estate planning revolves around moving from generation one to generation two. Now, estate tax has been modified, my God, close to 25 times. It got started, think about this, as a tax that was imposed on about 19 families, rich families in America, to finance the Spanish-American War. God love them. And that's what it was. That's what it was supposed to do. They needed some temporary funding to finance the Spanish-American War. They had no money, so they figured, let's tax the wealthy when they die. There were 19 families in America to help finance the war. Well, it's kind of changed over the years a little bit and has become a very hot political topic. So let's talk about the politics of this, because it's important, and where we are today and what's going to happen and what could happen and why. And then we'll talk about solutions, the various solutions, the philosophical and one very technical solution that can help everybody potentially deal with what's about to happen. So over the years, we have to understand, and again, this is not political. It's all about tax. That we'll call them the Blue Party, believes that wealth concentrating in the hands of a small number of families is not good for America. They just believe that. They believe that whatever it may be, that will turn into a banana republic with a wealthy class and an impoverished class. And the best way to deal with that is to break it down, force the sale of those assets, redistribute those assets in their arcane way, and move forward. The Red Party, on the other hand, has a stronger belief in capitalism. You work hard, take risks, sign personal guarantees, do all the things that we do, and we're successful in building wealth for our family. We want to do the best that we can to preserve that, as philosophically, for the next generation. Well, back in 2016, when Trump became the president, one of the things in, I think, the Tax Cut and Jobs Act, TCJA Act, was the elevation of the exemptions of the federal estate tax. How much can we transfer to our heirs without the imposition, and we'll call the percent, just so you know what it is, 40% tax. So before Trump, it was about a husband and wife, $5 million apiece, $10 million. So we could transfer $10 million to the next generation. Anything above $10 million, a 40% tax. Now, we say that glibly, but we need to understand what makes up the estate. Linda, it's everything. Business, real estate, intellectual property, life insurance. People say life insurance not subject. Life insurance not subject to income tax, but life insurance that we own is subject to estate tax. So everything that we own collectively, there's no tax between spouses unless the spouse is a non-citizen spouse, and it changes a little bit. But we'll cover that maybe a little later on, what happens with a non-citizen spouse. So no tax between spouses, but other than that, single person to the next generation, to ever, the imposition of the tax. So it was $10 million and 40% of everything above that. Now that $10 million has morphed with that TCJA Act to, as we sit here today, Linda, it's 27.22 million that spouses can pass to the next generation without the imposition of the 40% tax. Pretty good. Covers, I would say, 92% of Americans. Families are not going to be, and small businesses are not going to be impacted by that tax. Not necessarily true in our Vistage constituency, but true in general. And then on January 1st, 2025, just this January coming up, with a possible change associated with it, that tax will, because of inflation adjustments, it'll probably wind up about 28.5 million that can be passed to the next generation without the imposition of the tax. Also understand that if we give stuff away during our lifetime, there is another tax called the gift tax. And that tax is a tax on a same rate, 40% tax on any gifts above the threshold. So if I give over $28 million, if I give $30 million to my children, I have 28 million exemption, 2 million subject to gift tax, and a tax of $800,000. So I got to pay $800,000 to gift that extra $2 million. So where's the apocalypse come in? So the apocalypse comes in is that if we get a little bit of American government for everybody, a little bit of a civil procedure and civil process. So this was passed at a time that there was a Republican in the White House, a Republican-controlled House, a Republican-controlled Senate, but not a filibuster-proof Senate. So in other words, if filibuster-proof is 60 senators, majority is over 50 senators. And when they passed the Tax Cut and Jobs Act, which took it from that 10 million up to our current, call it $28 million, they could not make it permanent because that would have required a filibuster-proof Senate. So they used the process which was called a budget reconciliation. And budget reconciliation basically is for a limited period of time. That limited period of time expires December 31st, 2025. By autopilot, nothing needs to be done. And what happens? We drop from 28 million back to $12 million when we wake up on January 1st, 2026. That, Linda, is an imposition of a $5 million tax increase on family wealth moving from one generation to the next. Ugh. All right. Now, that's where the apocalypse. So that's what's coming. All right. And more likely than not, that's what's going to happen because government needs to do nothing other than be dysfunctional. And that will automatically, they don't have to do anything for it to reach that point. So let's examine what could happen because we have an election coming up in November. So in the election in November, if we have mixed government, I don't care, red, blue, doesn't matter, purple, as long as the House, the Senate, or the White House, one of them they're not all in unison. What we just said is going to happen. We're going to get that 12 million and 40%. Gift tax will drop to 12 million, 40%. Generation skipping tax drop to 12 million, 40%. And I'll explain generation skipping tax in a little while. Ugh. But we could have a different outcome. So let's talk about the outcomes because people are thinking about those outcomes. And sometimes they want to wait to take action until they see an outcome, which could be a fatal mistake that I'll explain in a moment. So let's say we get all red. All right, we got a red White House, a red House, and a red Senate. But the same thing, we don't have a filibuster-proof Senate, but we're all red. In all likelihood, more likely than not, the current estate tax exemptions will remain in effect. They'll pass law to make it remain in effect to keep it at the 28 million and indexed for inflation, at least until the next political change comes about. Shouldn't be tax policy shouldn't work that way based on politics, but in this case, it sadly does. So that would be a good outcome from a tax perspective. But we have the other side. We have a blue White House, a blue Senate, and a blue House. Well, let's tell you what they've said. What they have said and published is that the exemptions between spouses combined will drop to 7.5 million. It will no longer be indexed for inflation. The tax rate will be between 50 and 55% that happens everything above that. That, my God, is a walloping confiscation level of taxation for most capitalists in America. Odds of that and the odds of it being all red or all blue, not so great, but that's what it is. But they also said, and this is the linchpin, the blues, that even though they may pass that legislation in March, April, or May of 2025, 2025, which is to be the first time they'd be eligible to do that. It's not going to wait till January 1st, 2026. They're going to make it retroactive to January 1st, 2025. So in that particular area, should that ever happen, we have not the longest runway to deal with this taxation. But I also don't think that that we're going to see any side that's unanimous, given at least best gut feeling that I have and the best that we can interpret as far as tax policy is concerned. So let's talk. So that's the apocalypse. It's coming, right? More likely than not, and it's scary. And a lot of people do not realize, Linda, that everything is included in the estate. So what are our options? All right, what can we do about it? And we're going to spend some of our time now talking about that. But even when we talk about our options, we have to understand our options very well. When we're talking about a number, it's the number today. There's also, if people live a normal lifespan, there's appreciation on the value of assets. Assets continue to grow in value. All right. And if we don't have an adjustment for inflation, that just increases the tax burden. And a lot of people that, they have real property or they have debt service, and the debt service is getting amortized. So you have a delta that's opening up. So it's not just today's estate tax, it's the estate tax in 15 years or 20 years from now, where a $12 million estate can now be a $25 million estate subject to 40 or 50% tax. It's the destruction of everything that they've built. Why is it the destruction? Being a Vistage chair, what does this look like? What is the signature of a typical net worth of business owner? Well, the vast majority of net worth involves in the valuation of their business, or businesses, and real property. Not only their house, but maybe the building, where they have the plant, where they work. This is not liquid assets. All right. And when the estate tax is due 9 months from the date of the second death or the date of the first death, if they're single people. The government doesn't take a piece of the property and a piece of the business. They get cash on the barrelhead. And the goal of the government is that you can't pay it. So what do you have to do? You got to sell real property. You got to sell businesses. And in doing so, the government reaches its goal, the breaking down of the wealth transition from one generation to the next. That's the goal.
They do an audit. The government audits.
Every single estate tax return is audited in America by an estate tax attorney that works for the IRS if it's a taxable estate. Every single one. So that's their goal. And so a couple of factors that we all have to understand. Well, you and I know, Linda, that if someone's got a gun to your head and says, hey, you got to sell this business or this real estate within the next few months, we're not going to get the best and highest price. Okay, cool. The old estate sale, meaning that you can get it cheaper. All right. Now, the other thing they don't control in the estate tax is the market conditions. Well, what happens if we're in a recession? What if real estate prices are down 30%? What if the business is during a downturn period? We've all seen that, Now that business, which could have sold for $15 million, could only sell for 10, waiting for the next business cycle, but death interrupted it. And now I have to pay an estate tax. Ugh. So the cost of the estate tax could be really, really high. Appreciation, market conditions, liquidity, all come to play. It's devastating. And people that they spend more time planning a vacation than understanding this issue. And the government's hope is that they will continue to plan for their vacation and not do, because they want to see the blue side anyway, a breakdown of wealth from generation 1 to generation 2. So what people do. So what decisions people make. All right. So let's go through them. So one decision, interestingly enough, is to do nothing. There are a lot of people who do absolutely nothing. Throw their hands up in the air and say, hey, look, we don't care. Our kids didn't do a thing. Kids don't deserve it anyway. If they're going to pay tax, they're going to pay tax. We're doing nothing. Or we'll wait and see. Maybe they'll repeal this tax. Maybe the country will take a turn to the right. They do nothing. And that is, by the way, an okay decision if that's okay for the family. once they understand the impact of what that decision is. It's okay. If someone says, yeah, look, you guys, you're going to have a $12 million tax and could actually cost 15 to $16 million between costs and fees and market conditions. And they say, we got it. We understand it. My kids will still get 14 million between the two of them, $7 million a piece. Good enough. We're done. Okay. That's fine. So that, and then their planning really is just avoidance of probate, making sure there's a good game plan for the kids, but they don't get heavily involved. They're not the majority of people, but it's a decision. Another decision that gets made, not infrequently, is the proper utilization of life insurance. So what happens is spouses or individuals buy life insurance policy. Because when does life insurance policy pays off? It pays off on death. When do we need the liquidity? On death. So we kind of throw the burden onto the insurance company, transfer the risk to them, die. We get a pile of capital, of liquid capital, use that liquid capital to pay the government for their taxes. And now our businesses and our properties and our other assets can move to the next generation without having to be broken down. In other words, we create the pile of liquidity. So a couple things that we need to understand about that. One, not everybody is eligible to get life insurance. Health conditions are such that they can't get it. If they got issues that they can't get life insurance. Two, although the estate tax is paid, you'll never pay it because it's transferred to the next generation. Life insurance premiums have to be paid now. So it does take a bite out of their budget. It could be not an insignificant premium that people have to pay each and every year to the insurance company in order to buy the necessary liquidity to pay the tax. But people do that. They're saying, we'll do that. We'll pay $50, $70, $80, $90,000 a year to XYZ insurance company. We got it covered. We got the pile of liquid capital. But you have to be sure that the acquisition of that insurance, Linda, is acquired in an appropriately designed insurance trust and not on our own. Because if we buy it on our own and we're the owner of the life insurance, guess what? That life insurance policy is in our estate and subject to taxation. So I buy a $10 million policy to pay taxes. And if that $10 million policy creates $4 million worth of taxes, that wasn't very smart. If I buy that $10 million policy in an appropriately crafted and designed life insurance trust, then that $10 million is not only income tax free, it's also estate tax free. So it's very important in the way in which they make the acquisition of that product in order to fund that. And there are other uses of life insurance because if you think about it, it's basically people buy and sell businesses. They buy reps and warranties insurance. They buy earthquake insurance. They buy, flood insurance. This is just buying estate tax insurance, coming at a time of death. A lot of people do it and it works very successfully. So that's another one. But there are a lot of people that they just don't want to pay the premiums out of their current budget, or they can't afford to pay the premiums out of current budget. And all life insurance is paid with after-tax dollars. So what is the next thing that people actually do, which is actually quite popular? So let me share this one with you. It's called, we do quite a bit of them. It's called, we do a lot of this called over and under estate plan. And just we do this estate planning, strategic estate planning all over the country, just for our audience to know. So the over and under is we modify the basic living revocable trust. And here's what we say. We say, hey, look, all the assets that are free from federal estate taxes, just formulaic, go to my children with all the bells and whistles associated with that. So if it's $12 million worth of exemptions, you got 2 kids, each kid gets $6 million because that's not subject to estate tax. Everything that is subject to estate tax would go to the Linda Goldstein Foundation. All right. And the Linda Goldstein Memorial Foundation. And my 2 kids will run that foundation and are entitled to get paid to run that foundation. And we don't set up that foundation. It's not, we kind of set it up in advance, but it's born upon your death. And it's not an irrevocable move. So It's a bunch of paperwork now, but under those circumstances, Linda, there will never be an estate tax. So if the exemption is 12 million, 12 million goes to the kids. If the exemption is 30 million, 30 million goes to the kids. What goes to the foundation is that which is subject to federal estate tax. The foundation is the last great tax shelter in America. Kids can run the foundation. They can receive reasonable income for running that. For example, Chelsea Clinton makes $2 million a year running the Clinton Foundation. So children can run the Goldstein Foundation and might have, $10 million, $12 million that's in it. And then so there's no estate tax. But then if the family bought some life insurance in a life insurance trust, there would also be, in addition, for example, to the $12 million exemption or the $28 million exemption, maybe another $5 million policy to add more liquidity for the children if we wanted to do so. And they get jobs for the children, grandchildren, great-grandchildren, great-great-grandchildren working at the foundation. Not a bad thing, and quite attractive, by the way, to individuals of higher net worth who culturally say, how much is enough for the children so we don't create trust babies, and let the children work at the foundation, let them get paid, and let them do good things because I was successful. And if the estate tax is repealed, then that foundation never gets born. So it's quite popular, relatively inexpensive to do. It's language that's in an estate plan. People gravitate towards that one quite a bit. But now we'll go, so it's the utilization of charity, along the way. Now we have another procedure, which I want to spend a few minutes to talk about, that you'll hear a lot about, and it's really quite an extensive legal procedure, but the benefits of it are really, really good. And it's one of those where, Linda, you got to keep your eye focused on the brass ring at the end. What's the benefit? Because the steps in getting there are a little bit more challenging. And we'll just name it for you, which we would create in spouse scenario, two what they call non-reciprocal spousal lifetime access trusts, colloquially known, Linda, as SLATs, spousal lifetime access trust, non-reciprocal spousal lifetime access trusts. So we've done probably in the last 4 years about 250 of these legal procedures. So let me walk you through what that looks like. So first, let's talk about what's the benefit. So for us in our constituencies, it allows us today to lock in the $27-28 million exemption for the family. So that means when that exemption drops down to 12 million, which more likely than not it will on January 1st, 26, this family or our family will have locked in the $27 million exemption that was available today. Hooray, hooray, hooray. That's a big win. That's $5 million to the children. Tax protection for them. $5 million. But it doesn't end there, because another thing, if we live a normal life, depending upon the age of our clients, they could live 15, 20, 30 more years. All of the assets that are in those two buckets, those slat buckets, all of the appreciation on those assets also escape estate taxation. So we may have loaded it up with $27 million worth of businesses and real property, and now that businesses and real property are worth $50 million at the time of death. That would have been $20 million worth of taxes. No tax. So that's really interesting. We have some clients that we did this for about 12 years ago. They loaded it up about 20 million, and some of those assets are worth today $100 million. So it would have beat almost $40 million worth of taxes. This is overwhelming. And the third major benefit that comes with creating non-reciprocal spousal lifetime access trust is all of the assets that are inside those respective buckets that we put in to gain those exemptions are asset protected from the claims of creditors. So if a spouse crashes the car, has a rotten business deal, gets sued, we're an asset protection law firm. All the assets that are inside the Linda and spouse, for example, trusts are off limits. So that's a pretty good. So even if everything else didn't move, right, and we had or even needed for estate tax purposes, the asset protection benefits are overwhelming. So that's the brass ring: asset protection, asset appreciation, and lock in the current exemptions in doing spousal lifetime access trusts. So that's the good. What's the bad? So let's do the bad a little bit. So we have a transparent understanding in this, but most people, when they evaluate it, are good with what I consider some of the cons that are associated with it. So the first con, if you would call it a con, it's a complicated procedure. So once you decide to build spousal lifetime access trusts, you have to, draft and craft all the language that's associated with them. Be Linda for spouse, spouse for Linda. All the rules, all the regulations, who are the trustees, who are the trust protectors, what's the story with the kids, how are the kids going to inherit, how do you protect the kids, how do you set up trust for the kids? All of that has to be done. And you have to identify which assets go in which trust. That's step one. And if they're in a community property state, then they have to transmute those assets. So separate property assets are being gifted between spouses. And what we're really doing is we're just taking your current, Linda, $13.5 billion exemption and using it today rather than waiting until you die. Because when you die, it's not $13.5 billion anymore. So it's a lifetime utilization of the death time exemptions. And we're able to do that. So that's one thing. And then the other thing too is that the next in the we'll call it in the logistics of establishing those trusts there, which is not a con, but when Harry puts stuff into the trust for the benefit of my wife and my wife for the benefit of Harry, the IRS doesn't accept the value that I put on it. So if I say I'm putting 50% of my business in and 50% of my business is worth $10 million, IRS says, how do we know it's not $20 million or $30 million? So everything other than stocks, which you can measure, cash, which you can measure, easily measurable assets, we need to engage an independent third-party appraiser that stands up and will evaluate the value of those assets which we're gifting into the respective spousal trusts. This is what they said it's worth. They're willing to defend the valuation. We could even get the appropriate discounts required based upon the restrictions that we build in. So we have a valuation process that we have to go through. Not cheap, but again, worth it when you keep your eye on the prize. Then, of course, once that's done, then in the year following, we do have to file gift tax returns with the federal government, which secures our exemptions. There's no tax associated with it. It's just an informational filing that we need to do, but we need to do that. So there are steps that are involved. The other step that's involved is, and all of this stuff is pretty much done by the law firm. The other step that this is the logistical aspects of it is that, remember, I kept using the words non-reciprocal. The government has a doctrine, lovely doctrine, called the reciprocal trust doctrine. So if you created a trust for your spouse and spouse created a trust for you, so spouse trust for Linda, Linda trust for spouse, and they were identical. They looked the same. All that was different is on one was Linda's, the other is spouse's. The government would collapse it and say, you didn't do anything but swap names on a piece of paper, and all that crap is back on your estate. Ugh. So we have to craft them that they don't look alike. So we sign them on different days. We fund them with different assets. We do them in different jurisdictions. We have the provisions that are built in slightly different. We have slightly different trustees. The provisions for children are slightly different. So if a reasonable person looked at those two trusts, they say they're not identical. And then we avoid the reciprocal trust doctrine. Okay. So that's all the logistics of building that, but it's worth it. It's really worth it. At the end of the day, if one cares but you remember you had step 1, step 2, step 3. This is step 4. So step 1 again, remember, do nothing. So what are the cons? So that's the logistical part. Most of the logistical part is guided by the law firm. Basically, all clients need to do is sign here, sign there, and pay money to get it done. But again, the cost benefit is high. We calculated that the value of a fully funded, non-reciprocal spousal lifetime access trust, where people live a normal lifespan, on the average, is worth about $19 million to the children. And that doesn't even include the asset protection benefits. That's a lot of money that's saved in the family, and people who have them and understand them relish them. But there are some cons. So there's the cons. So, for example, I will use me as an example. Harry did set up a spousal lifetime access trust for my wife, Tess, and Tess for Harry. They are non-reciprocal. They're different enough. But we didn't give this stuff to our kids yet. All right. It's between spouses. So the control, this was the big deal. The control, the business control, the property control, all the income, the revenue, the dividends, the gains, all are up on the spousal level. If I would have given $27 million to my kids, I gave away $27 million. I don't own it anymore. The income, the dividends, and the gains are to my kid. Not going to happen. All right. But I could do it between spouses, but it also says that my access, Harry's access, to the pile of assets that are now owned by Tess, my wife, in her trust, is through Tess. And Tess has access to my assets in the trust that she gave to me is through me. So if she says, hey, I want you to take out $500,000 and let's take a trip to Monaco and go gamble, I can. If I say, hey, Tess, I want you to take out $1 million, she can. All right. Nothing to stop us from doing that. We don't have to file any tax returns. There's really no restrictions. May not be the smartest idea, but we can. So it's really wonderful as far as control is concerned and liberality. But what if Tess decides to divorce Harry after all these years? Too many years, by the way. Like I always tell everybody, I'm married 55 years, 10 of them happily. But anyway, so that's an old Hannah Youngman joke, Linda. You may have heard that before. So my access to that pile of assets is through Tess. The Tess says, bye-bye, I lose access to that 50% pile of assets that I gifted to her. Now, here in California, it doesn't make much difference because it would have been 50-50 anyway. So, hallelujah. In most states, Missouri, it doesn't make much difference. It would have been pretty much 50-50 anyway. But where it does make a difference is, let's say it was a marriage that was later in life. I had a large amount of assets, separate property, my assets. My new spouse had a smaller amount of assets. And then I gifted assets to my spouse to take up that $13.5 million. I've given it away. So if my spouse throws me out, then she keeps that $13.5 million. So that's a con. But we don't find that too frequently as an issue. What is an issue is death. So if my wife dies, then that $13.5 million pile, the Harry Trust for the benefit of Tess's $13.5 million now moves to my children. So now I own half. The other, the trust that she created for me, I have my $13.5 million. I have all the other assets that are in excess of the spousal lifetime access trust limitations, which is $27 million today. I have any life insurance that she left to me. But now those other assets have made it to the kids. In other words, the slat worked. Or it got it to my kids with no estate tax. It worked. But now my access to that pile is through my children. And if you have a dysfunctional family or dysfunctional family with children's spouses, that could get a little complicated. If you have enough assets that you don't have to worry about it, then it was successful. But they have to, you have to take a pause and say, okay, now I dealt with Tess, but now I'm dealing with basically the trustee for Amy and Brad. Does that continue to make sense?
Yeah.
And for some people, they worry about that. And of course, the solution would have been is if Tess had some life insurance on her life payable to me, I would have my half of the spousal lifetime access trust, all other assets, and the liquidity that she left me, all right, through some life insurance, and then I could easily dump the other assets on my children with all the appropriate bells and whistles and not worry about it too much.
Harry, it sounds like it's obviously a tailored blueprint for each family. You sit
Yes.
down, exploratory, find out
Yes.
what is appropriate, what
Right,
are,
and what the fixes are for the risks. In other words,
yeah.
life insurance, this, do that, along the ways. And the other thing too that people need to recognize is that one can have transactions with the trusts. We can lend money to the trust. We can borrow money from the trust. We can substitute assets in the trust. The trust doesn't have its own income tax bracket. It's really wonderful. It's amazing what you can do with these tools and save up, I'm telling you, $19 million for the family. Of course, someone's got $6 million worth of assets. Spousal lifetime access trusts are not for them. Because they're not going to have an estate tax. They're going to be below the $12 million threshold no matter what. So it's when you're above the 12, and when you're more than like approaching the 27, 28 million, it's going to get a reduction. That spousal lifetime access trust makes some sense. And then there are some basis considerations and other things, but it really, the way that I look at it is that vigilance needs to be looked at, because people don't recognize this. We have this very, very limited and wonderful opportunity. Linda, these are the highest estate tax exemptions that have existed in U.S. history that more likely than not are going to go away. We really should take advantage of them and try, like even in the slats, we can have LLCs, and the LLCs could be controlled by the managers of the LLCs. We could shape control, we can shape taxation, we can shape cash flow. There's so many things that we could do to benefit a family if they could just put on their thinking cap, analyze this, and not lose this opportunity. So that's why we talk about the apocalypse coming up, that we do have this runway. We don't know what the future looks like, but we know what we have available now, and they should be able to take advantage of that. And sometimes they say, well, that's all that complicates. Look, I buy a life insurance policy. Oh, well, kids have too much. Okay, well, let's set up, a foundation and move with the over and under. Any and other choices are fine that people could do so. It's really a great opportunity to lock in what we have today. And so you basically have, there's not many more. There are grantor retained annuity trust, GRATs. There are sales to intentionally defective grant, other ancillary types of more advanced trusts that can help a family freeze values, for example. If you have an appreciating asset, you got a piece of property that today is worth $5 million, Linda, that we expect that property to be worth $10 million in a few years. Or the business is going to have an equity event. It's going to be worth a lot of money. And so what you could do is and you say, well, that 5 million go to 10 million, that other 5 million creates $2 million worth of estate taxes. So what if we turn around and sold that appreciating asset to one of the slats and took back a promissory note, which we can. So it's worth 5 million or 10 million. And now I have in my estate a $10 million promissory note, and I have the appreciating business in the spousal lifetime access trust. So just put on your thinking cap for a second. In my estate, is that long-term promissory note going to appreciate in value? No. More likely than not, it'll have a discounted value because I got the present value of a future dollar, because it's payable over a long period of time. So I froze that at today's level. Now that business and property that's inside the slat appreciates from 10 million to 15 million to 20 million. It's all out of my estate. I saved millions of dollars of taxes and still controlled all of the assets. All of these tools are also subject to jeopardy, meaning that, God forbid, again, not political, we have a hostile tax environment. We'll call it a Biden type hostile tax environment. They not only want to take away our exemptions, bring them down to 7.5 million and tax the rate a lot higher, they also want to take away from people like myself the tools that we use to protect your clients, your constituencies, your members, and the people that are working really, really hard to build their businesses. That's why they joined Vistage. to build up build their businesses, not just to turn around and break it all down and give it to the government, but to get it to the next generation. Some of them want to know, you do it all the time, right? They want to get it to the kids or key management. Well, how do you do that if you can't do it because the estate tax has an imposition that comes in? So succession planning is interrelated to the estate planning. So this apocalypse is a lot bigger than anybody thinks it can be. Yet we have this wonderful opportunity, and that's why we did this chat with you this morning. So
Yeah.
that's about what I have to say. So we can open it up now for questions and answers if we
Okay.
have any. Paul, if you have any. Linda, if you have any. You've heard me speak
Well,
for
I just want to
40,
say,
55
Harry,
minutes.
Harry, this is wonderful. This is so much information. I was busy taking notes, and I'm sure the viewers were too. There's a lot of opportunity
Yes.
that you've told us about, but there's a lot of decisions that have to be made.
Yes.
And so could you tell me again when, well, besides doing this ASAP, when you really need to get some of these?
I really do think, it depends on what you're doing. So back at number one, do nothing. There is no time limit.
Yeah.
Buying life insurance, setting up a life insurance trust. You could do it almost at any time because as we get older, it's more expensive for health issues.
Mhm.
The over and under, where what's subject to estate tax goes to the foundation, what's under goes to the children, doesn't really have much of a time limit. That's probably in time in memoriam, never going to be any estate tax, but it has a family philanthropic aspect to it. If the
Mhm.
family doesn't have a philanthropic thing, no. But slats now it takes months to do them. They're complicated procedures. They need to work. And the way that I look at it is back to that vigilance thing. What everyone should do that has assets, everyone, is take this time. They don't have to do these things. They don't have to spend the money for them if they think it's not right or they're uncomfortable or they can't grasp it, but they
Mhm.
should analyze it now. They should know. You can't just be ignorant. They should know the opportunities in front of them and the steps that they would have to take in order to grasp those opportunities. That everyone should do, and the sooner the better, because people like myself that have the crafting, the ability to deal with this, firms like ours, there are not lots of us. There are lots of lawyers, but not lots at the level that we're at.
Mhm.
We ultimately will not be able to take care of people. We just won't have the bandwidth for the demands. Even we have 5,000 clients of our own who are trying to jam through the doors. We have like 30 lawyers that work for me, and we won't. It's they need to look at it. They won't be able to find appraisers. They won't be. The jam will be on because they waited too long. So it's better. What we've done in many cases is preset everything up and then maybe take a wait and see attitude. So if people are in ill health, if people are in their 70s or we'll call it even 80s and in ill health, and if one of them dies or if they die before the change happens, it's better that don't take us the wrong way. It's better that they died, from an estate tax perspective, because they died while the exemption rates were high. But if they live, then the exemption rates drop. They just increased $5 million for the family. So if they're in poor health, one of the things we do is we kind of create the slats, get everything done, but don't fund them yet. You preload the gun, but don't shoot it. It looks like we're in November, of 2025, and it looks like January 1's coming up. Looks like we're going to make it to January 1, 2026. We then, everything is done, baked, finished. We just load them up at that point in time. But we had the year to build them because these don't happen quickly. So I think vigilance is the right word. Vigilance is required and smart to do it. And here's what I say to Vistage people. I've done like 300 some odd Vistage talks, and this is always one that I said, you work your ass off on your business. You really do. And this particular planning for a successful family, you can't work hard enough. You're not going to make 5 million, 8 million, 10 million, 12 million for the family with some of the things that you're spending all your time on. How about spending a little time that is meaningful if you care? about moving your legacy from generation one to generation two. That put some time in there. It's worth millions of dollars to get that done, or at least hear all about it and then reject it if you want to. But at least you did eyes wide open, not eyes wide shut. And I think that's important.
Yeah, well, you answered one of the questions that was sent in is what is the timeline for the implementation of these changes? You answered that, and Linda, you were addressing that. And my last comment on this is that talk about Vistage and Linda, I know, it seems like the closely held businesses, it's just huge issue for them, the family businesses. Those are a lot of Vistage members that have those companies. And, I think this ties into them 100%.
Yeah, let me tell you how some Vistage chairs have utilized what we've done. So, Paul, why don't we go off record for a second? Stop recording.
All right. Well, I
Say
want to
thank
thank
you to
everyone
everybody.
for being here, and we'll see you next time, and stay tuned.